Yes, now I'm pleased to say is Franklin Templeton's Sonal Desai and JP Morgan's Thomas Kennedy as well. Sonal, let's just start with you. On this inflation debate, I know your position. You do not think this is as transitory as this Federal Reserve believes. Why is that?
So I just think that fundamentally, when people assume it's transitory, they're just looking at base effects. Of course, base effects are transitory. The issue is everything else we've just heard. We have never seen this quantity of monetary and fiscal stimulus come into an economy which is already doing very well because it's reopening. So essentially, you've got everything lining up. You've got supply bottlenecks, you've got commodity price increases, you've got a huge quantity of stimulus which continues to flow into an economy that is booming. It's an experiment we've never tried before. And so, yeah, I don't think it's transitory. I think that the Fed is very complacent, actually, about its ability to see through this and control it once it starts going up.
Tom Kennedy, does that resonate with you?
Not really, John, to be honest. I think you have a situation here where if the market was really believing that inflation was not transitory, we should start to see that in the price. The market is believing this flexible average inflation targeting regime, right? You can see forward expectations for inflation around 2.5%, maybe even a little bit above. But expectations in the long run are still very well anchored. You're talking around 2% for a five-year break even. So the transitory nature of this is consistent throughout market pricing. Now, what Sonia is saying is that there is an expectation that inflation will be higher, and that's true. It's in the price. But a notion that the Fed will be behind the curve is not in the price yet.
I would agree. I would completely agree. I'm not for a second thinking that the market actually has my view. I'm actually saying that I think inflation is going to be higher than is currently being priced by the markets.
Just add to that then, Tom. Why we haven't seen those higher yields? Because I'm expecting a big number tomorrow. We're already expecting a big number tomorrow. Pretty much everyone on the street is. Yet yields are south of 160. Why?
Yeah, no, I think that is the piece of the puzzle that really doesn't make sense. The Fed scorecard for substantial progress to me is pretty simple, John. You have to see that improvement in the labor market. As you've said, that starts tomorrow. Wide dispersion on what, or I shouldn't say it starts, it continues tomorrow, but wide dispersion on what that looks like. But then also their scorecard for substantial progress is belief in flexible average inflation targeting. And that box has to be checked, given what's in the price right now. This market right now is really doing the opposite of what you would expect. Relative to March, you've had inflation expectations pick up, the economy improve relative to expectations we had at that time. The Fed is getting closer to the substantial improvement or substantial progress towards its mandate, yet real rates have gone down, and the market has priced in a lower terminal rate. I mean, this is the opposite of what we'd expect, and there's a lot of short sellers of treasuries out there that are confused or frustrated.
Let me jump in. So now, your view on this, why that data hasn't catalyzed higher yields?
I think we're looking at points in time. And what I would say is I'm not anticipating that the yield curve continues to steepen in the way we saw it in several weeks. I think does it continue to grind upwards? Yes, as it starts sinking in. Something else I would note is that the market we've recently seen keeps pulling forward its expectation of Fed rate hikes. I'm not in that camp. I think the Fed is going to be enormously patient, but I do think inflation is going to be higher. So I'm calling for a longer and greater steepening of the yield curve, not necessarily the Fed reacting to inflation. They keep telling us they're not going to react to inflation. I think the market is assuming, based on what the Fed is saying, that we're not going to see that inflation beyond transitory, and transitory is being interpreted by the market as 3 months. I think there's nothing indicating that the Fed is going to respond if inflation lasts for longer than 3 months. They keep telling us they're going to see through it because they're, in fact, average inflation targeting. They could sit pat while inflation runs forward for quite a while. And I don't think the market is pricing that. That is my point. I don't think it's in the prices right now.
So, no, we're going to build on this conversation. You're going to stay close and stick with us alongside Tom Kennedy. Bloomberg's Abigail Dillittle has some breaking news for us in the last 10 minutes. Hey, Abby.
Hi.
Let's bring in the panel. Franklin Templeton, Sonal Desai, and JP Morgan's Thomas Kennedy still with us too. Sonal, how do you develop an outlook, put together a model, so to speak, when the range of estimates down in DC for what they might do next is anywhere between $4 trillion and perhaps zero. What do you come up with?
Well, what I do is look backwards first and look at the fact that we had 2.9 trillion last year in a year, and we did 2 trillion of it right before the economy shrank by a third. And we've already done 1.9 trillion this year. Now, the rest of it, I think we're already way over where we need to be for where the economy is. So pretty much anything, so we've been modeling it pretty much without any of this that comes through. 600 billion, 2.3 trillion, 1.8 trillion, wow, trillion here, trillion there. You know, you kind of lose count. We are already there. That's my point. With the 1.9 we already did, the 900 billion in December, and the 2 trillion, which we did last year. I'm not saying that none of it was needed. Of course it was.
Yeah.
But if you look at this year's, it's not clear to me what we're doing this for.
Looking at next year, I wonder if the peak in bond supply is in. Tom, this is the question coming from HSBC. I'll read out the quote. This year could mark a peak in bond supply, with the deficit projected to shrink significantly in future years, and their analysis looking for meaningful reductions at the longer end in longer-term auctions as a result. Tom, is that something you're thinking about too?
Yeah, we're thinking about the supply picture regularly to try to understand supply and demand dynamics, ability of foreigners to take down debt. Trying to map right now what infrastructure could look like, to your original point to Sonal, is very difficult, though. So to get those broad conclusions is tough right now. When you look at what Washington analysts are talking about for infrastructure, John, relative to what Wall Street is modeling, wide dispersion. Most of those folks down in Washington are talking about $3.5–4 trillion packages still as possible. Wall Street closer to $2 trillion. Huge wide range. Obviously, big implications for supply. But then in each package, differing implications for the economy. The Jobs Act actually would be productive and boost our expectations for 2022 and 2023 growth. So that's the package that you could actually see draw down on supply, whereas if you go forward with the human infrastructure side, it's actually hard to think the deficit can go down materially.
Tom, when you think about the range of supply that we might get, the range of stimulus relief, whatever you want to call it, infrastructure spending, anywhere between 3 and 1, does that change things for you? Does that mean a difference between 160, 180? Thomas Kennedy, to you.
It does mean a little bit, John, but I think that the going convention on the street that major changes in supply, really pushes rates is not statistically evidenced historically. Just some rules of thumb, like surprises of 100 billion can push rates around between 5 and 10 basis points. So there is wide dispersion. It can mean a lot for rates, but you have to have the offsets as well, John. What can growth do? How much of that can we offset by higher trend or higher potential growth? So I think the real takeaway for us on when you're trying to think about the outlook and what does it mean, the infrastructure package, is number one, to recognize the market is not good at pricing this far in advance, wide dispersion in estimates, and then there are generally going to be offsets on the revenue and the expense side. So can't focus on just one.
Sonal Desai, your response.
Well, I would say that the one thing which is missing in the conversation so far is the Fed. I mean, have we heard anything about the Fed not continuing to buy? That's all expansionary. And I think that it's essential to consider that and consider what's happening to the yield curve, not purely from a supply-demand perspective, but also from the factors we were talking about earlier, which is everything from inflation onwards. Because that feeds into people's demand and desire to hold treasuries at what potentially could be increasingly negative real rates, right? So I think that these are factors. It's impossible to look at just the supply-demand picture by itself and assume that's going to determine rates. I would like to think that if we saw a $3 trillion package coming down the pipes, yes, yields would widen, but in part because the market would work through it and also see that with this comes an overheating economy, a part of which would imply higher inflation rates. So it's tied together, is what I'm saying. And I always hear that, well, the Fed could start buying at the long end. That's fine when the economy is not growing as strongly as it's growing right now. Buying at the long end is also expansionary. So it's just very hard for me to see how you get out of this catch-22.
I just thought everyone would like a break from the Fed for at least 20 minutes, Sonal, and I was trying to reduce the conversation around it. I think, don't you want a break from it too? Sonal Desai there from Franklin Templeton. Good to catch up. Thomas Kennedy from JP Morgan. Thank you, sir. Coming up on this programme.